Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, August 19th, 2023. How you doing? Appreciate you coming to watch my weekend review. In this podcast, this is going to be the format. First of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily time frames and the weekly time frames. I'm going to discuss when I entered the trade, why I entered the trade, what strategy I used to enter the trade, and most importantly, how I am going to manage the position going forward, either to the upside or to the downside. It's very important in my trading, and if you've been watching this podcast for a while, you'll understand what I really look for when I'm talking to the long side. I'm really looking to see some type of rejection of a level below me, whether that's the 200-day moving average, the 250, the 300, possibly the 30 RSI. These are all deep dip buys. So a lot of the positions I've had are deep dip buys, but it's very important to see that level rejected so that you have the information that the market did not want to go lower than that level. Doesn't mean it can't, but then you need to position size correctly. You need to place your emergency stop. You need to place your end of day stop. I place my trailing stop level 1.5 ATRs above my entry. I start to scale out, take partial profits as it moves my way. Essentially, I have a full plan, whatever the market does. And I really suggest to you, if you're new to trading or if you're having issues with trading, please be patient. Wait for the market that you're trading to get to the level that you're looking for. Look for a rejection of a legitimate level, position size correctly. So you know exactly what your maximum allowed loss is going to be, but you need to have if-then statements. If the market does this, I'm going to do that. If the market does that, I'm going to do this. You have no control over the market, but you have to have an exact plan of what you're doing at all times. So I will take you through why I entered the trade, what was the entry signal, and then how I'm managing it going forward. So I hope it will be helpful for you. Hopefully it's helpful for you to get an idea of how I trade, how I look at things. And it was an interesting week. I mean, boy, we had a big down week. I had quite a few trades that did not work this week, but that's just part of trading. But I had some good ones that moved my way as well. So after we go through the particular trades, we're going to do a little bit on trader psychology. Always the most important skill in trading is the ability to create a plan and then actually execute and follow through on that plan, regardless of what the market's doing. Always helpful for me to teach trading psychology, and I hope it's going to be helpful for you. After that, I have gone down through my master watch list, both on the daily time frames and the weekly time frames, and I will point out what I'm looking for next week. Now, generally when I do this, the markets that I've highlighted are not to the levels that I need them to be, but because I do this on a Saturday, I try to show you in the coming week what levels I'm looking for and if they reject those levels. If they do, then I'll potentially take the trade. If not, then I'll just get on to another market that does. It's very important in trading to identify these levels and then just wait and be patient for them to come down, reject those levels, and then you can consider taking the trade. And then if they don't get there, you just don't take a trade, because eventually something will get there. So that's what we're going to do. Hopefully it'll be helpful, both on the daily time frames and the weekly time frames. I'll point out what I'm looking for. Now that we've had this market pullback, I'm very glad, actually, because now it gives us some good potential entries. A few weeks ago, everything was so high, there was hardly anything there to take, and I was mainly taking shorts. So, all right, so that's going to be the format, everyone. Hang tight. I have to run the U.S. legal disclaimer. I'll be back in about 40 seconds, and we'll get started. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started. Now, as I go through these, I'm going to tell you the approach that I'm using, the strategy that I'm using, and I'll show you the rules and the process that I'm using going forward. Now, if you're new to the channel, you might think, oh, there's a lot of rules there. And there are, but these are the rules I've developed over the last 28 years of trading. If you're interested in this, I do teach a private one-on-one stock trading course in the evening time via Skype. It's 15 total hours. It's one-on-one. It's just you and I'll teach you step by step all of these strategies. It's a great course. I just got done with a few students this week, so I do have some openings. So if you are interested and you would like to study and learn from me, my email is in the link of this description. Just email me and we can start a conversation. Okay, and then I will discuss the lessons more in detail at the end. Okay, so let's get started. Here we go. TLT. All right. I did enter TLT back on the 17th of August, and I entered at 93.44. Now, why did I take this trade? Well, on the surface, I took the trade because during the day we went under the 30 RSI and closed back over the 30 RSI. But in addition to that, we have some divergences forming. You see these channels here? These are the ATR or Keltner channels. And the previous low here, we got all the way down to the 6th Keltner channel. Then we rallied. Now we've come down. The day that I took the trade, is this lower than this? It certainly is. But the first low got to the 6 ATR channel. The second low on Thursday only got to the 5th ATR. So this one was lower than this one, even though the price here is lower than here. That is called an ATR divergence. Really what that means is the momentum of this move down here is stronger than this move. And so what it's implying is that we're running out of sellers. And if you run out of sellers, then the market generally goes up. In addition to that, look at the low here, and the RSI was deeper than it is here. Here we're much lower, obviously, but the RSI was not as deep. So we have both a ATR divergence and we have an RSI divergence, kind of setting the context that the momentum to the downside looks like it is waning, and the implication is it's going to go up from there. So whenever I have divergences, it doesn't mean I can just jump into the trade. I still need a legitimate entry signal, and the entry signal was on Thursday, the under 30 over 30. So when I see this, I took the trade, and it's very important to position size correctly. And I have a very good formula here that I've been using for many, many years that takes everything into account, especially the volatility of the market. So the first thing that I do is I generally take 1% of whatever my total trading capital is. Let's just say it's $100,000. 1% of $100,000 is $1,000. And then I divide it by the value of the 2 ATR. This is 2 times the average true range. Divide that by 2.47, it tells me to buy 404.85 shares. So I round up to 405 shares. Now, why is that important? Well, my maximum allowed loss in this trade was 1% of my capital, $1,000. So if I buy 405 shares and it moves $2.47, how much have I lost? I've lost $1,000. So I take my entry price minus the value of the 2 ATR, and I place that down here. So if the market does get down here, I immediately get out of the trade, and I've lost $1,000. But this is only going to happen about 5% of the time, because this is what's called your emergency stop. 95% of the time, if you have a loss, it's simply going to be your end of day stop. And the end of day stop is generally the reversal of why you enter the trade. I entered the trade because it went under 30 over 30. Therefore, let's say on Monday it closes under 30, then I'm going to get out. I'm not going to lose $1,000 because I only lose $1,000 if I'm here to my emergency stop. But 95% of the time, your loss is just going to be an untriggering of why you took the trade in the first place. I took an under 30 over 30. Therefore, Monday, Tuesday, whenever, if it closes below 30, I'm simply out for a small loss. And then for here, my emergency stop, I have that covered. And then that only happens 5% of the time. But I know if that happens, how much I'm going to lose. orange line up here is my 1.5 ATR trailing stop level. This is 1.5 ATRs above my entry. If I get to this level, now I go into trailing stop mode. I tighten up my stop. All right. And I have many examples that I'll show you that have reached that and then how I handle that. In addition, so first things first, we look for the confluence, the combination of indicators lining up, and then the trigger, right? We had the RSI divergence, we had the ATR divergence, we had the actual entry in the trade, which is under 30, over 30, position size correctly, emergency stop 2 ATRs below, end of day stop, close below the 30 RSI. So these are all defensive moves, right? Now, if we get up to the trailing stop level, then we go into trailing stop mode. That is also a defensive move. But an offensive move is that I take partial profits whenever it moves the value of 0.45 ATRs from the previous day's close. And so here we go. This is for Monday. It's 93.77 right now. So I would take 93.77. I would add the value of the 0.45 ATR to it, which is plus 0.56. So on Monday, my first profit target is going to be 94.33. I'll just put it in as a limit order for 10% of the position that I have left. So that's my first profit target. Then I'll add another 0.45 value to the first profit target. That gives me my second profit target, 94.89. Place that in the system. Take my second profit target, add the value of the 0.45 to it again, 95.45. That will be my third profit target. So I always set 3 profit targets based upon the previous day's close for the next day. And that is offensive. The position sizing, the stops, the emergency stop, the end of day stops, the trailing stop, well, those are all defensive. But I like to sell into strength if it goes my way. Not all of it, just a portion, 10% of the remaining shares that I have left. So you have to play offense and defense. So that's the setup. Under 30, over 30 in the context of the ATR divergences and the RSI divergences. Is it going to be a winning trade? I have no idea. So far it is, right? So far it was up 0.35% on Friday, and I am up approximately 0.35% on the trade. But I have no control, obviously, over what TLT is going to do, but I know exactly what I'm going to do. If it moves up, value of 0.45 ATRs, I'm going to take a little profit. If it moves up again, take some more profit. Gets the trailing stop level, then I go into trailing stop mode. If it closes under the 30 RSI, then I just get out for a loss. If it gets down to my emergency stop, then of course I get out immediately. So you have to have a plan, you have to have a process, and it's very, very important. It makes trading a whole lot easier. So TLT up 0.35% on the first day. So far, so good. Zions. Okay, Zions, great trade. It was a short trade. Back here on the 27th of July, we went over 70 RSI and under 70 RSI. In addition to that, we rejected the 200-day moving average. Now, this would have been a legitimate short trade right here. I didn't take it. It was a little extended from the 200. I wanted to weigh it back and see if we could get a little check back so I could get a better risk reward. And that is exactly what happened here. Oh, there was a dividend, so it messed up the things here. But anyway, I got short. 38.80 was the price. I placed my position size as I described earlier. I placed my emergency stop 2 ATRs above, and then my end of day stop is simply a close over the 200 because that's why I took it. Over 70, under 70, and the rejection of the 200. So this 200-day moving average is acting as resistance at the moment. So if it closed above the 200, I would simply get out of the trade. But if it goes my way, then I'm going to take partial profits, which is exactly what I did. So I took the trade here at 38.80, moved down, took some profits, moved down, took some more partial profits, got to trailing stop level. Once I get to trailing stop level, if I have a close above a previous bar's close, I will get out of half the position. I locked in 4.21%. Kept moving up, got close to 200 again, but held it. Remember, that was my level. Next day here, down, took more profits, then had some sideways motion, and then we started the down move in the market. took more partial profits here, took more partial profits here, got another partial profit here. So this particular trade doing very, very well from entry to current price on the remaining, up 11.69%. Pfizer. All right, Pfizer. Well, one of my favorite approaches and trading strategies is called a higher low V2. And so here is Pfizer. I did take Pfizer to the long side on the 16th of August. And with higher low V1s, V2s, you see the green lines here. This is what's called the value zone. Any place in between these green lines is the value zone. First requirement is we close below the value zone. We move into the value zone. We pull back, and then we have a V1 or a V2 that closes in the value zone. And this is higher low. Do you see how this low here is higher than this low? So when I see that trade, and I took this trade on the 16th, I position size. I saw the higher low V1, V2. I entered with a proper amount of shares. Of course, I placed my emergency stops 2 ATRs below. And then the stop on this particular trade is simply a close below halfway of the washout bar on the V1. And this is where you see this pink line here. If in the future I get a close below this, I'm simply going to get out. I don't have a 200 or 30 RSI to key off of. I'm keying off halfway of this bar, which is an important level. It's important 50% Fibonacci level. So entered here 35.43, place my trailing stop level up here 1.5 ATRs above. Next day, boom, ripped higher for me immediately, which is always a good sign to see your trade moving immediately in your direction. It hit 2 profit targets, so I took those off, locked those in. The market can't take that away from me. I reduced my position size, so I'm minimizing risk. And now I'm in trailing stop mode, which means in the future now, if I get a close below a previous bar's low, then I will sell half of the shares that I have remaining. So I'm in trailing stop mode, but we have not closed below a previous bar's low. This particular trade in 2 days, it's done very well, up 3.41%. Okay, so those are the current open positions. TLT up 0.35%, Zion's up 11.69%, Pfizer up 3.41%. Now these are the daily trades that I am out of, and I'm out of them because they hit my stops. But what you'll see with the trades that I take, and this, in proper trading, this is what you're going to want to see. You're going to want to see when you have a losing trade that you're out quickly. When you have a winning trade, you stay in it, right? You have to be very patient with winners. You have to be very impatient with losers. So when you see winning trades, I will be in these trades for quite some time. The losing trades, I'm out very quickly, sometimes a day or two. Here is Apple. All right. Well, Apple has really been struggling. I did take Apple back here on the 11th of August with an under 30, over 30, similar to the TLT trade that I just showed you. I position size. I placed my emergency stop 2 ATRs below. Next day did go up. Took a little profit off, thankfully. But on Thursday, we closed below the 30 RSI. That was my signal to get out of the trade. And I had a loss on this trade of 2.18%. So I'm out of it, done with that trade quickly because it closed below the 30 RSI level. KMX. All right. I did take KMX all the way back here on the 4th of August. The setup was called a return to value V2. Green lines are the value zone. We're above the value zone. We came into the value zone. We had sideways motion, which is the requirement. Then we had a V2. V2 consists of 3 bars. Bar 1, 2, 3. 2 goes below bar 1's low, closes above bar 1's close. Stop is halfway, a close below halfway of the washout bar. Next day, moved up nicely, took some profits. Next day, moved up again nicely, took some profits. And you'll see why that's important here in the future. Then we came down. We tested halfway of the washout bar exactly to the penny. It held the next day. Intraday, it went below but closed back above. Took some more profits off. Then we kind of moved sideways. And then on Thursday, we had a big move down when the market was down strong. and it closed below halfway of this washout bar. That was my stop. So I ended up losing 1.94% on this trade, but not really, because I locked in profits as it was moving my way. So it really reduced the loss, because I locked in profits, which reduces my position size. So if it does go down, I have fewer shares. So that's why I'm such a big fan of taking partial profits, not all, but partial, when the market gives it to you, because if you get a huge reversal like we did today, now I have fewer shares. All right, so this particular trade down 1.94%. Philip Morris. Well, I did take Philip Morris back here on the 14th of August. We had a bounce at the 200-day moving average. I took the trade here at 95.82. My position size, I placed my emergency stop 2 ATRs below. My end of day stop was simply a close below the 200-day moving average, and that happened the very next day. Got out for a small loss of 1.26%. But again, on the losses, you can see I'm out quickly. The winners, I let them run based upon my process. So Philip Morris did lose the 200-day moving average, immediately got out for a loss of 1.26%. And then last but not least, on the closed out trades on the dailies, I did take LMT back here long side on the 31st of July with the rejection of the 300 simple moving average. I got long 44.80 position size, placed my emergency stop 2 ATRs below. My end of day stop is simply a close below the 300. Next day moved up, took some profits off, which you'll see was a good thing. Moved down, continued to hold the 300-day moving average, moved up again, took some profits, moved up again, took some profits, moved up again, took some profits. But then here on the 15th, it just boom, closed below the 300-day moving average. I had to get out of a loss for 0.5%. But again, wasn't quite a loss, 0.5%, because of the days that I took profits. And then look at this. I got out, immediately went back up, but that's trading, and that's how it works. So tough week in the markets for the bulls, obviously. So some of these signals didn't work, but the key point is that they didn't work. Get out quickly, reset, wait for a new setup. Be patient, wait for a new setup. So review on the closed trades: Apple down 2.18%, CarMax down 1.94%, Philip Morris down 1.26%, and LMT down 0.5%. All right, let's go over to the weekly charts. And these trades I've been in for a long time. Okay, I did take XLF, which is the financial sector ETF. I took it all the way back here on the 24th of March with the rejection of this 250-week moving average. So I position sized correctly. I placed my emergency stop 2 ATRs below. My end of week stop on this trade is simply a close below the 250-week moving average. I placed my trailing stop level 1.5 ATRs above. So enter the trade, moved up strongly, took profits. Another bar here, moved up strongly, took some partial profits, got to trailing stop level. Now I'm looking for a close below a previous bar's low. Doesn't happen, doesn't happen, doesn't happen. Move up again, took profits. This particular bar here on the 23rd of June had a close below a previous bar's low, so I got half of the remaining position for a gain of 6.4%. Then we had another 4 or 5 weeks of moving up and taking profits. Now, once I get to a 65 RSI level, now the 5 EMA will come into play. If I have a close below the 5 EMA, I'll get out of the entire position. If we get up to the 70 RSI level and rejects the 70 RSI level, then I will also take another half of the remaining positions off, and then I'll get out of the rest if I have a close below a previous bar's low after rejecting the 70 RSI. I know it sounds complicated, everyone. It's really not, but again, this is why I teach private one-on-one lessons, because I teach you all these rules step by step by step. And when you're done, you will have a very good trading process using good trading principles, and I promise you it won't seem complicated, because I can imagine if you're new to this channel and you see all these rules, you're thinking, oh, this is just so confusing. But it's really not, everyone. It's really not. But the remaining shares that I have on this particular trade here, up doing very nicely, up 9.68% on the remaining shares. But this is just a good example of, look, if the next week when I purchased this, the next week if it had just closed below, I just got out quickly for a small loss. But because my process told me to stay in, it was doing well enough for me to stay in. You see how long I've been in this trade? These are weekly bars because I'm letting it run. I'm letting it do its thing. If it closed below, I would immediately get out because, again, be very patient with your winners and be very impatient with your losers. So XLF up 9.68%. All right, XLRE is another weekly trade. Took this trade all the way back here on June 2nd. This is another higher low V2 entry. We closed below the value zone. We moved into the value zone. We pulled back. We created a V2 entry. I got long at 36.32. I position size correctly. I placed my emergency stop 2 ATRs below. My end of day stop is simply a close below halfway of this washout bar. So got here long at 36.62, moved up, took some profits, and we had to move all the way back. But do you see how it's interesting how we came right back to the halfway of the washout bar and closed below it? The next week opens below, touches it, immediately bounced, took some more profits off. Next week moved up again. Then we got to trailing stop level finally, took more profits there. And then 2 weeks ago, we had our first close below a previous bar's low. I took half of the remaining position off for a gain of 2.12%. And this week, of course, we had the big down move. But do you see how, again, it literally got to halfway of this washout bar here and stopped? So the remaining shares I have, this, I guess, are at a loss now, slight loss of 0.41%. But my trailing stop is going to just be a close below halfway the washout bar of 35.79. So quick recap on the weeklies. XLF remaining shares up 9.68%. XLRE down slightly, 0.41%. All right, let's head over and do a little trading psychology, everyone. Always the most important skill in trading, the ability to create a plan, follow your plan. This is from Mark Douglas. If you don't know who Mark Douglas is, you really should find out. He wrote a great book called Trading in the Zone. I think one of the best books ever on trading psychology, so I highly recommend it. Let's see what Mark has to say. Excuse me. 95% of the trading errors you are likely to make will stem from your attitudes about being wrong, losing money, missing out, and leaving money on the table. The 4 trading fears. And this is really true. When you distill it all down, these are the 4 issues that people have, the trading fears they have. And let's kind of talk about them. 95% of the trading errors you are likely to make will stem from your attitudes. Number 1, being wrong. You know, I see very often with students and other traders that there will be a perfect setup. They won't take the setup for whatever reason. They're scared, obviously, because maybe what they read in the media or just what the market's doing. But you really need to overcome that and just take the trade. If it's a legitimate trade, take it. Because so often you'll get a legitimate trade, but people will get scared about taking it. They won't take it, and then they'll see the trade move and take off. So about being wrong, you have the setup, but you don't want to be wrong, so you don't take the setup. And very often, if it's a good setup, more times than not, it will be right, but you don't want to be wrong, so you don't take the trade. So my suggestion and what I do is I don't care how I feel about the market. If it's a legitimate trade, I take it long. I take the trade. Losing money. Well, losing money goes hand in hand with being wrong, because if you think you're being wrong, that you're going to lose money. But yes, the fear of losing money, of course, is a reason why people don't take the trades. But again, if it's a legitimate trade, I always take it. Missing out. This is a huge one. You know, I have parameters of where I'm going to buy something and where I'm not going to buy something. And I don't buy anything over the value zone in most of the approaches that I use and that I teach. And I can show you example after example after example that if you buy over the value zone, that it's going to usually come back to the value zone, and that you'll lose money. What I'm saying here is don't chase things. There are certain levels where I don't care how good the news is, you just don't chase them. You want to buy in value, sell above value. You want to buy below value, sell in value. But the missing out portion, the FOMO, fear of missing out, has a huge impact on traders, especially new traders and retail traders. They read the news, things look good, they're just chasing things higher and higher and higher, and it almost always ends in tears. I mean, look at the rally we had over the last few months. People were up there buying, no fear whatsoever, and now look what the market is. So missing out is a huge portion of fear, but usually if you're like, oh, I don't want to miss out on that, it's probably moved too far already, and you're just better off waiting it for it to come back to a more reasonable level and leaving money on the table. They're scared of leaving money on the table, so they stay in their positions until ultimately it reverses back on them, because like, whoa, I don't want to miss out. It comes back to fear of missing out again, leaving money on the table. If you have a nice profit, if your process and your rules tell you to get out, just go ahead and get out. So the four trading fears are being wrong, losing money, missing out, leaving money on the table, and just once again, on the being wrong portion, if for me, for example, if I have a entry and it's legitimate, I don't care if I'm wrong, I'm just going to take it because that's my process. Losing money, again, if I have a entry, a legitimate signal, I can't worry about losing money. My system and my process tells me to take the trade, win or lose. Missing out, I'm not going to chase things up into the stratosphere because I have a fear of missing out, and I have rules and I have areas of where is a no-go zone where I just can't make the trade, and leaving money on the table. I scale out, I take my partial positions. If my system and process tells me to go ahead and get out, I just get out. I don't worry about leaving money on the table. So thank you, Mark Douglas. Appreciate this. Hope this was helpful, everyone. All right, let's get back to potential trades for next week. Again, these are not going to be, at the moment, these are not going to be where they need to be. I need to be patient and wait for them to get to these levels, and only if they get to these levels. Okay? All right. Apple. Well, I did just go ahead and get out of Apple on Thursday because the close below the previous bar's low, but Apple still is close to a potential entry for next week. Here the RSI is 29.08. That's a no-go zone for me. I need it to close back above the 30 RSI. So if Apple does close back up above the 30 RSI, I will consider getting in the trade. There are some divergences here. There's an ATR divergence. Here at this low, we got to the fifth ATR channel. Now we're lower, and we only got to the 4.5. So there is some divergences going on there. Over time, buying under 30, over 30s on Apple has always been a good idea. So I will consider getting back in Apple next week if it closes over the 30 RSI. Hey, and by the way, everyone, if you're enjoying the podcast so far, I would really appreciate it if you could just hit the thumbs up button. It helps to build the channel, helps to keep the channel around, lets YouTube know there's some valuable content. So if you've learned anything interesting today, please go ahead and try to hit the thumbs up button. I would appreciate it. BRKB has had a lot of relative strength. I mean, Apple, Microsoft, Tesla, they're all down here near the 30s. Berkshire Hathaway is right now inside the value zone. That's it. So the relative strength is very important. If the market bounces Berkshire Hathaway is more than likely to lead the pack up because it has not moved down too much already. So what I'm looking for next week is what's called a return to value V1, V2. And by the way, if you're interested in V1s or V2s, I have a free video on my YouTube channel in the lessons playlist called V1, V2 entries. And I do about 45 or 50 minutes there on this particular setup. It's a really, really good setup. It's one of the setups I teach in my one-on-one courses as well. They don't happen very often, but when they do happen, they are great signals. And in my experience, win rate somewhere between 75 to 77%. So here we go on Berkshire Hathaway. The green lines here is the value zone. We were above the value zone. Now we've returned to value. Remember, I don't buy up here. I don't buy above the 1 ATR channel. I want to buy in the value zone and sell up there to the people that are chasing up there. So we've above the value zone, we've come into the value zone. What I'm looking for now is a couple days of sideways motion. We've had 1 day of sideways motion. This bar here made the lowest low in the value zone. This bar went below but closed above the low. So now we have 1 day of sideways motion. What I'm looking for next week on BRKB is another day of sideways motion and then a V1 or V2 entry to get triggered into the trade. All right, so I'm looking for one more day of sideways motion and then a V1 or V2 entry to get triggered in. Caterpillar, well, this is also a return to value. We were above the value zone here. We've come into the value zone here. We have a day of sideways motion here. This is a legitimate trade for me. And by the way, Caterpillar also has a lot of relative strength. What I'm looking for on Caterpillar, Monday only, okay, Monday only is a close above 275.17. That would form a V2. Bar 1, bar 2 goes below the low of bar 1's low. On Monday only, if we close above bar 1's close at 275.17, that will be a legitimate return to value, sideways motion, and a V1, V2 entry. Then I'll position size correctly. I'll place my emergency stop 2 ATRs below. My end of day stop is simply a close below the washout bar here. But the V2 hasn't formed yet, but if it does form, I will definitely consider taking this trade. IWM, boy, you know, what a move down we've had in this market. Look at this move. This is bizarre. Now, this is a legitimate entry. This was a legitimate entry on Friday. We went under 30, over 30, and we had a intraday rejection of the 200-day moving average. This is legitimate, but I decided to pass and not take this trade because the risk to reward between the close of Friday and this 200-day moving average is quite large. And if it just moves up, I'll miss it, and that's okay. What I'm looking for, because this was a legitimate entry on Friday, what I'm looking for on Monday is a move back down that either retests the 200-day moving average or simply just a move back down to give me a better risk to reward ratio. Because if you bought this on Friday, this is legitimate. So if it's legitimate and moves down, then the person in the trade would continue to hold it. But if I'm not in the trade and I'm not in the trade because I skipped it on Friday, if it moves down a little bit more, then it just gives me a better risk to reward ratio inside of an already valid trade. So just to recap, if it moves down, holds the 200, but gives me a better entry price, that will be a potential for me. Or if we move back down, retest it, and gives me a better risk to reward, then I would also consider it. QQQ. All right. Well, the Q's obviously having some issues here. Huge move down. Now, under 30, over 30s, I use those all the time on individual stocks, but I always like to have a confluence or a combination of indicators like divergences, V1s, V2s, something like that, to not just the under 30, over 30. But when it comes to indexes like the Qs and the SPYs, an under 30, over 30 is enough for me. And right now we are at 34.73. We're oversold, but really a more legitimate oversold level would be an under 30, over 30. And on indexes, that's really all I need. So I am really looking to see on Qs if we can get a bounce at the 30 RSI or an intraday rejection of the 30 RSI, or a close under and then close back over the 30 RSI. So that's what I'm looking for on cues. And again, I talk about not chasing the price up here above the value zone. I mean, people just had to have these positions up here. They just had to have them. Why? Because the news was good. Do you remember the mantra that was being discussed a few weeks ago? How we're going to all-time highs. The market can't go down. Oh, yeah, it can. Look, it did. Right? So again, being patient, waiting to buy in the value zone with the legitimate trigger. But now I think we're getting to a point where we have a great risk to reward ratio on a significant move back down. I guarantee you the people up here would be much happier to buy down here than they did up here. Can you imagine being stuck in that trade all the way up here and just watching it go straight down? So on the cues, what I'm looking for next week is an under 30, over 30. SPY, same thing. We're at 35.23. It's amazing how when you get to 30 RSI, all of a sudden buyers appear. And so that's what I'm waiting for on SPY, and under 30, over 30. A close under, close over the 30, or an intraday rejection of the 30 RSI. Tesla. So a couple options here on Tesla. And this actually gives us a bunch of good options. Right now we're at 2740. We're under the 300-day moving average. Now, in the next week, if we were to close above 30, that would also close us above the 300. That would be a nice confluence of signals, right? Because we're at 2740 and we're under the 300-day moving average. So a close back over the 300-day moving average would also give us a close back over the 30 RSI. Most likely, that would be a nice confluence. However, if it goes lower, some kind of rejection of the 250-day moving average here would be legitimate. Probably my favorite would be a pullback to the 200-day moving average. I think that would be the best entry point, but it may not get there. The market doesn't care what I want. So potentials here are a close above the 300-day moving average and the 30 RSI. If it moves lower, rejection of the 250-day moving average. And if it moves even lower, a rejection of the 200. But again, people buying up here way above value, not happy they bought up there. Verizon. All right. I pointed this out for, I think last week, almost got a higher low V2. Closed below the value zone, moved into the value zone, pulled back, almost got the V2. Here was day one. Day two washes out day one's low. On Friday, if we would have closed above day one's close, it would have been a legitimate higher low V2. It didn't happen, but next week we could go lower and create a higher low V1 or a higher low V2 as well. And it's a little hard for me to point this out because I don't have the bars in the future to show you. So I'm just trying to explain, but go and watch my YouTube video called V1, V2 entries, and I have many examples there. All right. Last but not least, XLV Healthcare. This one's fairly simple. I'm looking at the 200-day moving average. Look back in the past. We closed under the 200, over the 200. Trade worked great. We came back down, rejected the 200. Trade worked great. Does it mean that next time, if we get to the 200-day moving average, it's going to reject and it will bounce again? I don't know. But looking back in the past to see if the moving average that you're keying off of was respected, if it was respected in the past, it's more than likely to respect it in the future. And it did respect it here. It did respect it here. Will it respect it here? I don't know. But the chances are greater that it will because it did in the past. Okay. So real quick recap. Apple looking for an under 30, over 30. Berkshire Hathaway looking for another day of sideways motion, a couple days of sideways motion, and then a potential V1, V2 entry. Caterpillar looking for an entry long on Caterpillar Monday only if we close above 275.17. Russell 2000, legitimate trade on Friday, just looking for a pullback or a rejection of the 200, another rejection of the 200-day that gives me a better risk to reward ratio. QQQs looking for a simple under 30 over 30 or rejection of the 30 RSI. SPY, looking for a rejection of the 30 RSI or an under 30 over 30. Tesla, a couple options here, few options here. Close above the 300-day moving average and also close above the 30 RSI. That would be one. Number two, rejection of the 250. Number three, rejection of the 200. Verizon, looking for a V1 or V2 entry in the value zone, and then XLV, just a rejection of the 200. Now, it's potential that all of these markets could trigger on the same day. So does that mean I would take all of the signals? No, I only take one signal per time frame per day. So I'll only take one daily swing trade. And if I have 5 of them, I have to narrow them down to what is the best trade. And how do I do that? Which one had the most confluences of signals? Which one had the best risk to reward ratio? Which one had the best relative strength? Were there convergences, ATR divergences, RSI divergences, MACD divergences involved? I look at the higher time frames. Which one had the best support on the higher time frame? See, this is the devil's in the details here as far as you can have a handful of potential entries, but narrowing down the best ones based upon all the criteria that I just discussed. And this is really what I teach you in my one-on-one course. I mean, these the nuances of which one to take really important. So, if you are interested in working with me, I promise you, you will really like the course. It's a world-class course, and learning anything one-on-one, I believe, is the best way to learn anything, having your teacher right there, and we'll get to know each other well. It's 15 hours, and I throw lots of curveballs at you, and but I just really want my students to succeed. So consider it. My email's in the description. All right, let's go to the weeklies. Not a lot on the weeklies, but some potentials here. Here is Etsy. Well, Etsy, if you remember, I like on individual stocks. I don't just like under 30 over 30s. I like confluences. Well, right now, Etsy on the weekly bars is at 35.47. So an under 30 over 30 would be my trigger. But do you see what we have? A MACD divergence happening here. Here's the low. See how deep these red bars are? Then we rallied, got some green, MACD. Now we are lower than this low, but you see how the red bars here are not as deep as over here? This is a MACD divergence. This is showing from a MACD perspective that this move down is running out of momentum. So big picture, contextually, I have a double bottom with the bullish divergence, which is bullish, but I still need the entry trigger, and the entry trigger would simply be the under 30 over 30 to get me into the trade. Rio Tinto, RIO. All right, I am looking for the 200-day moving average. And again, just like Etsy, there is a double bottom bullish divergence forming here. You can see here we have the low, deep red MACD bars. We've rallied into green. We have not yet tested this low, but I can just tell from experience that even if we do come down, these bars are not going to be as deep as these bars, giving us a MACD double bottom with bullish divergence. But I still need the trigger to get me in. And the trigger right here and right now, from what I can see, would simply just be a rejection of the 200. Would make a lot of sense. And then Tesla. Well, Tesla, this is on the weekly. Look back in the past. Did the 200-day moving average act as, did it work? Did it respect it? It did. Had a close under, close over, off to the races. So this is what I'm looking for here on Tesla, is a pullback to the 200-day moving average. Now, I don't know if it's going to get there. If it doesn't get there, I'm not going to take the trade. But if it does get there and reject it and give me a good risk to reward ratio, that will be my entry. So real quick, Etsy, recap, under 30 over 30 in context of the double bottom bullish divergence. Rio, context of a potential double bottom bullish divergence rejection of the 200. And Tesla, no double bottoms bullish divergences, but just the key off the 200-day moving average would make sense. So I hope that was helpful, everyone. Like I said, if you like the podcast, I'd appreciate if you hit the thumbs up button. If you're interested in studying one-on-one with me, just send me an email. Email's in the link in the description. The course costs $1,750, but it is very well worth it. It's an investment. I've been teaching for years. I've taught people all over the globe, from absolute beginners to seasoned hedge fund managers. So if you have an interest, just send me an email. I also have an online video course available at udemy.com called the Deep Dip by Stock Trading Approach. It's a great course. It's 9.5 hours of video. It's very affordable. It's only between $12 and $15. And I teach you step by step in that video course how to trade the deep dip buy approach that I've been showing you here today. I have sold so many of these video courses around the country, around the world, and have had so many good reviews and feedback. So, of course, one-on-one course, always better, because more personal touch and you have me directly. But if that's not an option, then this is a very affordable course and to get you started. And I always like to leave off at the very end with the most important thing. Please try to go out, do something nice for another human being today. Please try to go out, do something nice for an animal today. It would just make the world a better place if we all would do one nice thing for each other each day. It really would make the world a better place. So I appreciate you being here, everyone. I hope you have a good rest of your weekend. If you have any comments or questions, just leave them in the comment section. I'll do my very best to reply to those. But I hope you have a great week. Be careful next week. The market's been volatile. Let the trade come to you. Let it come to the area, and let the price action of the market that you're looking at prove to you that it's rejecting that area. So anyway, appreciate everybody. God willing, I will see you next week, and we'll see what happens with these crazy markets. Until then, have a good one.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.